$100 billion. That is the exact amount of United States Treasury debt that China has liquidated in a breathtakingly short window, sending shockwaves from the trading floors of Manhattan to the policy rooms of Washington, D.C. This isn't just a rounding error on a balance sheet. It is a calculated, systemic withdrawal from the very bedrock of the American financial system. As we sit here in early 2026, the latest Treasury International Capital data confirms a grim milestone. Beijing's holdings of U.S. debt have plummeted to a 17-year low, hovering near $680 billion, a staggering fall from their trillion-dollar peak. For decades, the chimerica bond was simple. They sold us goods, we gave them dollars, and they lent those dollars back to us to keep our interest rates low. But that bond has just been incinerated. With the U.S. national debt spiraling past $36 trillion and interest payments now exceeding $1 trillion annually, the world's second-largest economy is no longer just diversifying, they are heading for the exit. Is this the beginning of a liquidity death spiral for the dollar? Or is the U.S. economy more resilient than the headlines suggest? This is Finance Uncovered, and today, we are pulling back the curtain on the $100 billion dump that everyone is talking about, but few truly understand. Before we dive into the mechanics of this financial divorce and what it means for your bank account, make sure to subscribe to Finance Uncovered and hit the notification bell. We track the movements of global capital so you can stay one step ahead of the crash. To grasp the magnitude of what just happened, you have to understand the historical context of the Treasury trap. For nearly 20 years, China was the primary enabler of American deficit spending by purchasing massive quantities of U.S. government bonds. They essentially provided the cheap money that fueled everything from the housing boom to the pandemic stimulus packages. But in the current landscape of 2026, that relationship has turned toxic. The catalyst for this $100 billion sell-off isn't just one factor. It's a confluence of geopolitical survival and a fundamental loss of faith in the U.S. fiscal trajectory. When Washington weaponized the dollar by freezing Russia's foreign reserves in 2022, Beijing didn't just take notes, they began a total re-engineering of their reserve strategy. They realized that their $1 trillion nest egg was effectively a hostage. If a conflict over Taiwan or trade routes in the South China Sea were to escalate, their savings could be deleted with the stroke of a pen in a DC office. Consequently, the People's Bank of China has been aggressively swapping paper promises for physical reality, becoming the world's most consistent buyer of gold for 14 consecutive months. The velocity of this shift is what should keep every bond trader awake at night. In November 2025, China's holdings fell to $682.6 billion, the lowest level since the 2008 financial crisis. This isn't just selling, it's a strategic retreat. Because bond prices and yields move in opposite directions, a massive sell-off by a major sovereign holder puts upward pressure on interest rates. When China dumps $100 billion, it forces the US Treasury to offer higher yields to attract new buyers. For the average American, this is where the macro becomes micro. Higher Treasury yields are the benchmark for everything else: your mortgage, your car loan, and your credit card interest. We are entering a regime where the cost of borrowing is no longer dictated solely by the Federal Reserve, but by the appetite or lack thereof of our global rivals. If the biggest buyer becomes the biggest seller at the exact moment the US budget deficit is expanding by $2 trillion a year, the math simply stops working. Furthermore, we must look at the Ponzi-like mechanics that some top Chinese economists are now openly criticizing. Xiao Yu, a prominent economist from Fudan University, recently described the massive accumulation of US debt as a cycle where larger volumes of new debt are required just to pay off the old ones. In 2026, the US is spending more on interest than on its entire defense budget. From Beijing's perspective, the risk of US debt unsustainability is no longer a fringe theory. It's a mathematical certainty they want no part of. By reducing their exposure, they are attempting to insulate themselves from a potential dollar shock or a sovereign credit downgrade that could devalue their assets overnight. They are choosing to take the mark-to-market losses now, rather than face a total wipeout later. But it isn't just about fear. It's about a pivot toward a multipolar financial order. While China is dumping US debt, they are simultaneously expanding their influence through the BRICS network and settling trade in yuan. They are building a walled garden economy that bypasses the dollar-dominated SWIFT system. Every $1 billion they move out of treasuries is $1 billion they can reinvest in the Silk Road of the 21st century, ports in Africa, lithium mines in South America, and semiconductor hubs in Southeast Asia. They are trading IOUs for hardware. This shift represents a fundamental change in how global power is measured. In the 20th century, power was the ability to borrow. In the 2020s, power is the ability to own the physical supply chain. The internal pressures within China also play a critical role in this $100 billion liquidation. Their own economy is currently operating at two speeds, while their export sector remains robust, growing by 5.4% despite the trade war. Their domestic property market is still in a state of managed collapse. To support the yuan and prevent a catastrophic flight of capital, the People's Bank of China needs liquid dollars to intervene in the foreign exchange markets. Selling treasuries is the most direct way to get that cash. However, this creates a dangerous feedback loop. Selling treasuries drives up US rates, which makes the dollar stronger, which puts even more pressure on the yuan, forcing them to sell even more debt. It is a high-stakes game of financial chicken, where the loser faces a systemic currency crisis. We also have to consider the trade war factor. With the US imposing historic tariffs in late 2025 and early 2026, the diplomatic relationship between the world's two largest economies is at its lowest point in decades. Many analysts see this $100 billion sell-off as a financial shot across the bow. By dumping debt, China is demonstrating that they have the leverage to cause turmoil in the US bond market whenever they choose. It's a message to Washington. If you target our exports with 60% tariffs, we will target your borrowing costs. While the US Treasury officially maintains that the market for treasuries is deep and liquid, enough to absorb any selling, the reality is that the buyer of last resort, the Federal Reserve, is already struggling to manage its own balance sheet without reigniting inflation. The implications for US fiscal dominance are dire. For decades, the US enjoyed what the French called exorbitant privilege, the ability to run massive deficits because the rest of the world had no choice but to hold dollars. But that privilege is being eroded in real time. If Japan, which remains the largest foreign holder, follows China's lead to support its own struggling currency, the US could face what's known as a failed auction. This is the ultimate nightmare scenario. A moment where the US government offers debt for sale and the world collectively says, no thanks. In that scenario, interest rates wouldn't just rise, they would moonshot, potentially triggering a localized version of a Great Depression for the 2020s. However, some contrarian voices in the market argue that this is not a crisis but an orderly transition. They point out that while China and India are selling, US allies like the UK, Belgium, and France have actually increased their holdings to record highs. Total foreign ownership of US debt actually hit a peak of $8.5 trillion recently, despite China's retreat. This suggests that the safe haven trade is still alive, even if the players have changed. But this is a dangerous assumption to make. The quality of a safe haven is determined by the long-term solvency of the debtor. When your two largest creditors, Japan and China, start trimming their positions simultaneously, it is a signal that the global financial architecture is shifting beneath our feet. What we are witnessing is the dismantling of the global order that was built after 1945. The era where the US consumer bought everything and the rest of the world funded the bill is over. China's $100 billion dump is the physical manifestation of a financial divorce that has been brewing for a decade. As we look at the numbers for 2026, the trend is clear. The US is becoming increasingly reliant on domestic buyers and friendly allies to fund its lifestyle. But as inflation remains sticky and the national debt continues its vertical climb, the question isn't whether China is in troubles, whether the US can survive without its primary banker. This shift has also fundamentally changed the bond vigilante dynamic. In the past, bond vigilantes were private investors who sold debt to protest fiscal irresponsibility. Today, the bond vigilantes are sovereign states. China is no longer just an investor. They are a strategic actor using their balance sheet as a weapon. This $100 billion isn't just a sell order. It's a vote of no confidence in the long-term value of the American dollar. And as the US prepares for another high-stakes election cycle and further fiscal expansion, the world is watching to see who will blink first. The transition toward a de-dollarized world is no longer a conspiracy theory. It is reflected in the official data. Every dollar that China moves out of treasuries and into gold or hard assets is a brick removed from the foundation of US hegemony. We are entering a period of fiscal dominance where the government's need to fund itself will override all other economic concerns, including the Fed's mandate for price stability. As China continues this $100 billion trend, the margin for error for the US Treasury becomes razor thin. One policy misstep, one failed auction, or one aggressive tariff could turn this orderly retreat into a full-blown financial rout. As we move deeper into this analysis, we will look at exactly how the Federal Reserve plans to counteract this nuclear option and why the private sector might be the only thing standing between the US economy and a total debt collapse. The story of the $100 billion dump is more than just a headline. It is the opening chapter of a new era in global finance, an era where safe isn't what it used to be, and where the rules of the game are being rewritten in real time by a creditor who is no longer willing to play. The $100 billion liquidated by China isn't just a number. It is a symptom of a much deeper, more structural fracture in the world's financial plumbing. As we move into 2026, the data from the Treasury International Capital Reporting System is painting a picture of a world that is fundamentally reevaluating the safety of the American dollar. While China's holdings have hit a 17-year low of $682.6 billion, the real story lies in the yield pressure this creates on the US government. For every $1 billion that China dumps, the US Treasury must find a new home for that debt. But here is the problem. The pool of willing buyers is shrinking at the exact moment the supply is exploding. By January 2026, the US budget deficit for the first quarter of the fiscal year has already hit $602 billion. To fund this, the government must issue more bonds when the largest foreign player in the room is selling instead of buying. The laws of supply and demand take over. Yields must rise to entice private investors, hedge funds, and domestic banks to pick up the slack. This creates what economists call the interest trap. By early 2026, the US has reached a dubious milestone. Annual interest payments on the national debt have officially crossed the $1 trillion mark. For the first time in history, the United States is spending more just to rent its past debt than it is on its entire national defense. Think about that. The interest bill is now larger than the cost of maintaining the world's most powerful military. In fact, through the first few months of FY 2026, net interest outlays reached $179 billion, outpacing every other government spending category except Social Security. When interest costs grow faster than the economy itself, you aren't just running a deficit. You are running into a war. China knows this math. By dumping $100 billion, they aren't just making a political statement. They are performing a strategic divestment from a debtor they believe is heading toward a sovereign credit crisis. This raises a critical question. If China is out, who is in? The traditional answer has been the Federal Reserve. For years, the Fed acted as the buyer of last resort through quantitative easing. But the Fed is currently trapped in its own balance sheet trilemma. To combat the sticky inflation that has persisted into 2026, the Fed spent much of the last year in a quantitative tightening QT phase, actually shrinking its holdings. While they signaled a shift toward reserve management purchases in late 2025 to ensure market liquidity, they cannot simply print money to buy up all the debt China is dumping without risking a 1970s-style inflationary spiral. This leaves the US Treasury increasingly dependent on price-sensitive buyers, private hedge funds, and international investors who demand higher returns to compensate for the risk. This shift in the buyer profile of US debt is making the market more volatile and the government's borrowing costs more unpredictable. We also have to look at the geopolitical contagion effect. China isn't acting in a vacuum. Under the BRICS framework, we are seeing a coordinated effort to build alternative payment rails. At the Rio Summit in late 2025 and moving into the 2026 meetings in India, the agenda has shifted from talking about de-dollarization to building it. The Reserve Bank of India has recently proposed interconnecting BRICS central bank digital currencies, CBDCs, to bypass dollar-based settlements for interblock trade. While a single BRICS currency remains a distant prospect due to the massive economic diversity between Brazil and Russia, the interoperability of their national currencies is a real and present threat to dollar dominance. If these nations no longer need dollars to buy oil or electronics from each other, they no longer need to hold massive reserves of US Treasuries to facilitate that trade. This reduces the structural demand for the dollar, which has been the primary driver of US financial power for 80 years. The weaponization of the dollar has accelerated this trend. The precedent set by the freezing of Russian assets remains the single most significant. Psychological trigger for central banks in the global south. Beijing has observed that financial assets are now political assets. In response, they have shifted their focus to hard commodity sovereignty. Instead of holding $100 billion in paper debt, China is increasingly holding physical gold and industrial metals. The People's Bank of China has increased its gold reserves for 14 consecutive months, contributing to the record-breaking gold prices we are seeing in early 2026. They are trading a liquid but risky asset for an illiquid but certain one. This is a classic flight to quality move. Except this time, the quality isn't the US Treasury, it's the vault. But is America truly in trouble, or is this just a rebalancing? Proponents of the American resilience thesis argue that the US economy remains the most innovative and productive on Earth. They point to the 2025 to 2026 AI investment boom, which has pushed US tech output to all-time highs and attracted massive inflows of foreign private capital into US equities. While China is selling bonds, the rest of the world is still buying stocks. This creates a capital divergence. The US government is struggling to find creditors, but US companies have no trouble finding investors. However, this creates a dangerous disconnect. If the government's borrowing costs continue to rise due to the lack of sovereign buyers like China, it will eventually crowd out private investment. Higher yields on government bonds act as a gravity well, pulling capital away from the stock market and into the safe return of the bond market, potentially popping the AI valuation bubble. We must also consider the currency war aspect of this $100 billion dump. The yuan has faced immense pressure as China's internal property crisis continues to simmer. By selling treasuries, Beijing gets the dollars they need to prop up their own currency and prevent a total capital flight. It is a defense mechanism as much as it is an offensive strike. But this defense has a cost for the US as China dumps dollars to buy yuan. It puts downward pressure on the dollar's exchange rate. In a high inflation environment, a weaker dollar is the last thing the Fed wants, as it makes imports more expensive and keeps inflation hot. This forces the Fed to keep interest rates higher for longer, which further increases the US government's interest bill. It is a vicious cycle where every move by Beijing makes the Fed's job exponentially harder. The role of the bond vigilantes has also evolved. In the 1990s, they were seen as a check on government overspending. Today, the biggest bond vigilante is a sovereign state with a geopolitical agenda. China's exit is a signal to the rest of the world that the risk-free rate is no longer risk-free. When the world's second-largest economy decides that $100 billion of your debt is a liability rather than an asset, the market listens. This is why we are seeing thinner market liquidity in early 2026. The gap between what buyers are willing to pay and what sellers are asking for is widening, a classic sign of a market that is becoming fragile. In a fragile market, even a small shock like a minor tariff escalation or a disappointing jobs report can lead to a flash crash in bond prices. Furthermore, we are seeing a shift in global financial loyalty. Countries like Saudi Arabia and the UAE are increasingly following China's lead in diversifying their trade away from the petrodollar. As of January 2026, the share of global trade settled in yuan has reached an all-time high, while the dollar share of global reserves has slipped below 58%. While 58% still sounds dominant, it is the direction of the trend that matters. For 80 years, that number was effectively 100% for the Western world. The erosion of the margin is where the danger lies. If the US loses its ability to print the world's reserve currency with impunity, it loses its ability to fund its massive military and social programs without a balanced budget, something Washington has unseen in decades. This brings us to the fiscal dominance regime. We are entering a period where the Federal Reserve may be forced to abandon its inflation target simply to keep the government solvent. If Treasury yields spike too high because China continues to sell, the Fed may have no choice but to restart quantitative easing to cap those yields. This is what's known as yield curve control, and it is the final stage of a debt crisis. It is a moment where the central bank admits that the market can no longer price the government's debt on its own. In early 2026, many analysts are watching the 10-year Treasury yield with bated breath. If it crosses the danger zone of 5.5% or 6.0%, it could trigger a systemic collapse in the regional banking sector, which is already sitting on hundreds of billions in unrealized losses on their bond portfolios. The $100 billion dump is the canary in the coal mine. It is a warning that the symbiotic relationship between the world as producer and the world as consumer has officially ended. China is no longer willing to fund the American lifestyle if that funding is used to build a containment strategy against them. They are taking their chips off the table and moving them to a new table, one they built themselves. This isn't just a trade war anymore. It is a balance sheet war, and the US Treasury is the primary battlefield. The Chimerica era is over, and what comes next will be defined by a much more volatile, fragmented, and expensive global financial system. What is most concerning as we look at the start of 2026 is the lack of a plan B in Washington. The political consensus remains focused on further spending and further tariffs, both of which increase the deficit and alienate our creditors. While the US continues to rely on the extraordinary privilege of the dollar, China is preparing for a world where that privilege no longer exists. They are building the infrastructure for a post-dollar era, and this $100 billion liquidation is just the beginning of the transition. The safe haven is being vacated, and the rest of the world is starting to look for the exit sign. As we move into the final phase of this $100 billion liquidation, the focus shifts from the why to the how. Specifically, how the US Federal Reserve and the Treasury Department are planning to survive this strategic divorce. By early 2026, the Fed has been forced into a corner. To counteract the China dump, they have quietly pivoted from quantitative tightening to what insiders call technical accommodation. This means that, while they aren't officially printing money to fund the government, they are expanding their balance sheet through Treasury bill buybacks to inject liquidity into a system that is starting to gasp for air. By January 2026, the Fed's net liquidity indicator has surged as they attempt to offset the $600 billion in overnight financing spreads that have widened due to the lack of foreign buyers. They are essentially trying to replace Chinese capital with digital ink. But in an environment where inflation is still hovering near 3%, this is like trying to put out a fire with gasoline. The US Treasury, led by Secretary Scott Bessent in the current administration, has resorted to front-end loading to keep the 10-year yield from crossing the psychological 5.5% debt zone. The government is shifting its debt issuance toward short-term bills rather than long-term bonds. This is a desperate attempt to find captive buyers among money market funds and the rising sector of USD, which in 2026 have become one of the top 20 largest holders of US government debt. While this keeps the lights on today, it significantly increases rollover risk. By 2026, the US must refinance nearly $9 trillion of its debt within the next 12 months. If interest rates remain high because China and other BRICS nations continue to exit, the interest bill will consume nearly 25% of all federal tax revenue by 2027. This is the definition of a debt trap. China's $100 billion move has also triggered a gold rush among central banks that is reshaping the concept of global value. In January 2026, gold prices shattered records, hitting $4,600 per ounce. This isn't just speculation. It is sovereign hedging. Central banks, led by the People's Bank of China and the Reserve Bank of India, are swapping their paper promises for physical bullion at a rate not seen since the end of Bretton Woods. They are preparing for a post-dollar architecture where a new unit, currency, a gold-backed digital asset for intra-BRICS trade, could potentially offer a way to settle multi-billion-dollar energy deals without ever touching a US bank. In early 2026, the Enbridge project involving China, Thailand and the UAE has already processed over $15 billion in direct bilateral transactions. Proving that the technological plumbing to bypass the dollar is no longer a theory, it is a functioning reality. The final rule change in this saga is the emergence of financial balkanization. As the January 2026 deadline for the forced sale of TikTok passes, we are seeing the rise of technology and capital walls. Foreign investors are no longer just looking at return on investment. They are looking at return of investment. The $100 billion dump is a signal to every sovereign wealth fund in the world that if your interests clash with Washington's, your assets are at risk. This is leading to a home bias where capital stays within its own geopolitical bloc. For the US, this means the exorbitant privilege of the dollar is being replaced by the exorbitant cost of self-funding. The American consumer, who has relied on foreign-funded debt to maintain their lifestyle, is about to face the reality of a world where cheap money is a relic of history. As we look at the closing data for Part 3, the conclusion is stark. The $100 billion dump by China was not a random market event. It was the opening salvo in the geopolitical liquidation of the American century. The symbiotic bond that defined global trade for 40 years is broken. while the US remains a technological and military titan. Its financial foundation is being chipped away by a creditor who is no longer willing to bankroll its rival. The rules of investing have changed. Safety is now found in hard assets, geographic neutrality, and physical commodities. This has been a comprehensive look at the $12,000 word analysis on the rule-breaking shifts in global sovereign wealth. To stay ahead of the next $100 billion move and ensure your portfolio isn't caught in the crossfire of this financial divorce, make sure to subscribe to Finance Uncovered. We are tracking the flow of trillions in real time, providing the deep research facts that the mainstream media is too afraid to touch. Hit the notification bell. Leave your thoughts in the comments on whether the US can survive this post-China era, and join our community of global macro investors. This is Finance Uncovered, where we uncover the truth behind the trillions.